Is Silicon Valley real estate in a bubble? Coming up on this week's Silicon Valley Snapshot. This is Danny Gould with the Selling Silicon Valley Group. Welcome everyone to another Silicon Valley Market Snapshot for the second week here in February of 2021. But before we get into the numbers and the data, if you are a home buyer in today's marketplace and you're looking for a comprehensive data set to help you make the most educated buying decision possible, you can text the word data plus the zip code, area, or neighborhood that you're looking in, and we will get that information delivered straight to your inbox. And if you are a home seller in today's marketplace, you're looking for a comprehensive data set to help you price your property. Now more than ever, pricing strategy absolutely matters. Go ahead and text the word data plus your property address, and we will send that information straight to your inbox. So everyone, let's get into the data and let's get into the numbers. We're going to break tradition this week because as you've been seeing, if you've been watching these videos for any period of time, you will see that everything looks pretty much the same. Like the story has not changed over the last 4 to 5 months, which is the inventory levels across the Bay Area are extraordinarily low. And the demand is fairly high, and that has not changed. And last week we went into the January numbers and really dissected what we felt, or what I feel is going to happen throughout the remainder of this spring quarter in 2021. But the question on everyone's mind is this: are we in a bubble? Are we experiencing this? Is this faster than normal appreciation going to eventually lead to some sort of market correction? And before we kind of like delve into the hypotheticals here, just be aware that everything I say here is completely subjective. There is definitely arguments to be made for and against the housing market. Not just here, not just locally, but nationally, having some sort of correction in the near future. And obviously, if you've been watching my videos too, I've been pretty clear that at some point this market is going to stagnate. We are going to see a neutralization in the market, and that will likely come in some form of an increase in inventory levels, and perhaps a slight decrease too in buyer demand. Now the question becomes, where is this inventory going to come from? A couple of places that this new inventory could arise from. Number one, when you look at the inventory levels from last year, we had significantly less homes for sale than we would have anticipated for a good portion of the year, specifically from middle of March to like the end of May. There were very few homes on the market for obvious reasons, right? Shelter in place put a stop hold on normal buying and selling patterns. Buying patterns resumed to a level of normalcy faster than sellers did. So there were a lot more buyers in the marketplace than sellers, and that obviously put pressure on prices. And then we started to see the market appreciate. More homes came on the market, but at that point, the train had already started rolling, right? And that momentum has carried us through well through the fall, the winter time, and now into the spring of 2021. This train is not slowing down anytime soon. And the writing's on the wall, right? Like there is nothing that could, outside of something crazy happening, some sort of like disaster, going to slow this market down. Because of that, and because of all of that inventory that didn't get introduced to the marketplace, it's not like those sellers disappeared, right? There are natural ebbs and flows. The consistency of the inventory levels in 2020 were broken. And that inventory exists somewhere, because somewhere out there are hundreds of people that should have listed their home this last year, but didn't, for a variety of reasons. The majority of them, the reason that they didn't list, is because they are probably in some way, shape, or form kind of waiting out COVID-19. Well, guess what? We're here at the beginning of 2021. There's a plan in place to hopefully by the end of this year get to back to normal, right? Or as close to normal as we can possibly get. Once that happens, a lot of those sellers are going to resume their original plan, which was to sell, right? But instead of 2020, probably late 2021 or 2022. Between now and then, yes, there are going to be, the inventory levels are still going to be low, but that additional inventory will definitely impact the marketplace in some capacity, because it's not all going to come on at once. Obviously, it's not going to like just one day there's going to be 2,000 new homes on the market, but there will be, for a period of time, additional inventory from 2020 and 2021. I liken it to wedding venues. For the last year, there have been very few weddings, and so now what you're seeing is that once things go back to normal, you're hearing of wedding venues get booked up to 2024. It's very similar to the housing market in the sense that the people that were planning to do things in 2020 and 2021 will now be doing them in 2022, 2023, 2024. So everything's going to get pushed forward. And so it's not like all of it's going to happen at once, but there will be higher than normal inventory levels in a lot of areas, or higher than they should be, until everything kind of like equilibrates, if that makes sense. I hope I'm making sense. If I'm not, definitely leave a comment down below. But to me, it makes perfect sense. You had inventory that wasn't on the market for a significant period of time. All that pent-up inventory will slowly get released over a period of maybe 24 to 36 months, or more, right? But the vast majority of it will get released in that first 24-month period. So that's number one. Number two, forbearance, and forbearance leading to foreclosures. This is definitely a topic that I'm talking about. I have empathy for those that have been impacted and are not able to make their home payments right now, the mortgage payments. It is a tragedy what's going on right now, but it's something that definitely needs to be discussed. There's good news and there's bad news. The good news is that 51.5% of all forbearance have now been paid in full, right? 33.2% have worked out a repayment plan. 15.3% are still in trouble, meaning they don't really have a loss mitigation plan. They don't have a plan for what's going on. So there's a really great quote by Rick Sharga at RealtyTrack. According to the Mortgage Bankers Association research from July 2020, when borrowers began exiting the program through the end of the year, about 87% of them did so with a repayment plan in place. Their loans reinstated, their missing payments deferred to the end of the loan, or paid off the loan, or had a loan modification in place. All positive outcomes, right? The remaining 13% of homeowners who left the program without a repayment plan of some sort in place are the ones who are probably most at risk of going into default. If these numbers remain consistent, about 325,000 people will exit the forbearance program over the next 6 to 9 months without a plan in place. Some, but probably not all, of those loans will likely default, right? Some, not all, of those loans will default. 325,000 people. This is nationally. Right? So all the homes in the world, all the homes in America, 325,000 of them are at risk for going into default. In the grand scheme of things, not that many. And when you come to the Bay Area in particular and analyze that, I wish we had some way of measure or some way to get that data. If you are out there, you're watching this video and you have access to that kind of data, let me know. I'd definitely be willing to pay you some good money for that data. I'd be interested in seeing. I have a funny feeling we're lower than the national average, and not only that, but we're appreciating at a faster pace than the national average right now, which means that even if people were to default, the likelihood of them defaulting and not having a significant amount of equity is fairly low. In fact, there is a great Black Knight data chart that shows the distribution of loans in active forbearance by current combined loan to value, meaning how much equity do they have in their property. If you look at this chart, what it's telling you is that 41% of loans in active forbearance have less than a 60% combined loan to value, meaning that they have over 40% equity. And then 18 have more than 30. And then 17% have over 20, and then 14% have over 10, over 10, right? And then there's only, if you look at those last two, those are the ones that we want to focus on, only 10% of the active loans in forbearance have less than 10% equity in their home. So when you go back to the 325,000 homes, or 325,000 people, apply that same math, only 32,500 of them have less. If we just kind of like deploy that same math, it's probably not that. It's probably a little bit more, maybe like 50K. But if you're looking at those 50,000 people that have less than 10% equity in their homes, so those are the ones that are at risk for foreclosure. Everyone else will perhaps be forced to sell their home, but not at a loss, and it won't be repossessed by the bank. It will be a forced sale. But there is a big difference between being forced to sell your home and getting foreclosed on so that the bank is then selling it at a loss. There is, or close to a loss, huge difference there, guys, right? Huge difference, because in one case you're selling it, they still have equity in the home. In another case, it's carnage. So when the question arises, are we in a bubble, or are we going to expect some sort of like massive housing crisis? Very interesting CoreLogic statistic. In 2010, 25% of homes were underwater. Today, in 2021, only 3% of homes are underwater, meaning that they have less or negative equity in the property. So when you look at that chart there, I mean, it should tell you right away that this is nothing like the housing crisis in 2010. Yes, homes might be appreciating at a rapid rate here in Silicon Valley. Yes, there might be some leading indicators of inventory levels rising. No one's arguing that. The inventory levels cannot stay this low for long. But the difference here is that right now, the banks, everyone, they're not lending funny money. This is real money that's being lent out to real buyers that have real money. And so, yes, homes are appreciating quickly. Yes, I do expect there in the next 6 to 9 months to be a neutralization in the market because inventory levels rise. The point is, though, is that between now and then, the market's going to continue to appreciate. And whatever neutralization that occurs in the market, I've been saying this for such a long time, whatever appreciation occurs over the next 6 to 9 months will not be completely mitigated or will not be completely offset by any sort of depreciation that occurs after that neutralization and perhaps even a decline. Meaning the market appreciates 10% in the next 6 to 9 months. There will not be a 10% fall after the market neutralizes. It will not be that drastic. History we have history books on our side to show that sort of thing does not happen very frequently, and there's no data in the marketplace right now to suggest that type of significant correction would occur. And so for anyone that's sitting there and thinking, well, is now the right time to make a purchase? The answer is duh. And you should have made it 6 months ago, but you didn't. And now you're in the same spot that you were 6 months ago, trying to game the market again. And the answer, the question I ask myself is, why are you tormenting yourself? Why do you keep doing this to yourself? Why are you torturing yourself? Just buy the house and allow the market to do the work for you, because you're either going to pay now or you're going to pay later.
You own a home, but you want to buy a new one. But before you can do that, you need to sell your current home. The Selling Silicon Valley Group makes it easy. We will get you an all-cash offer for your current home to take it off your hands and give you the money to buy your new home. You move when you're ready. We don't really need your house, so we'll put it on the market and work to sell it for full market value at the highest possible price. The best part is, if and when the home sells for more than what we paid you, we send you a check with the difference. You can get the full market value of your old home, and you get to move into your dream home on your schedule by yourself without the hassle, with the Selling Silicon Valley Group's exclusive trade-in program.
There's no deal in Silicon Valley. The deal is getting the house. And the market has proven that again and again and again and again. Sellers, don't wait until the market neutralizes. Don't wait till the inventory levels get high. And it's not going to be. This isn't going to be. I'm running late on time, but I just want you guys to understand from a seller's point of view. If you're looking at the numbers and you're like, wow, this is great. Well, guess what? Every seller has access to the same information that you do. And we are not going to see inventory levels like change drastically overnight all over the county. It's going to be a guerrilla attack, meaning 1 month it's going to be this neighborhood and this neighborhood. All of a sudden the inventory levels are going to start creeping up, and then it'll be another neighborhood, and then it'll be another neighborhood. It's pockets and pockets and pockets of real estate where you start to see the inventory levels rise. It's already happened in a couple of marketplaces in the peninsula, right? Namely, like Mountain View. Have you seen what's going on in Mountain View? It's not as seller friendly as it once was. Have you seen what's going on in Palo Alto? I mean, it's not like all like sunshine and roses there. It's kind of a tough market, right, for sellers. The same thing, right? The trickle-down theory, this selling Silicon Valley trickle-down theory is whatever happens up there eventually comes down here. And it's not going to happen overnight. It's going to happen slowly, and you won't even know it's happening until it's too late. So don't be that seller that just kind of sits there on the sideline waiting for the peak to happen. The peak is like now, right? Like in the next 3 months, there will be an apex somewhere, and then it is downhill from there. So don't squander this opportunity, is basically what I'm saying if you're a home seller, because right now the inventory levels are so low in so many places here in the Bay Area. Contra cost accounting, my goodness, what's going on there is just unreal. I mean, it's unreal. That's all I got for you guys. Again, if you're a home buyer in today's marketplace and you're looking for a comprehensive guide to assist you with your home buying purchase, go ahead and text the word buyer guide to the number down below, and we will actually get that guide delivered straight to your inbox. And if you're a home seller looking for a comprehensive guide on how to effectively sell your home for the highest possible price in Silicon Valley and in the San Francisco Bay Area, you can text the word seller guide to the number down below, and we will get that delivered straight to your inbox. This is Danny Gould, everyone, with the Selling Silicon Valley Group, and I will catch all of you in the next video.